So you're trying to make sense of the stock market, maybe cut through some of the noise and get to what really matters.
Uh-huh.
Well, you're definitely in the right place. Today, we're doing a deep dive into the thinking of a legendary investor, Peter Lynch.
Ah, Peter Lynch. Yeah.
Specifically, we'll be exploring his classic book, Beating the Street.
And his track record, I mean, it really speaks for itself, doesn't it?
Hmm.
Head of the Fidelity Magellan Fund, those incredible returns.
Absolutely.
And his book, it's great because it offers a really accessible roadmap for individual investors. People who want to navigate the market without getting totally overwhelmed.
Exactly. It's about understanding how you can find opportunities, how you can make informed decisions.
Mm-hmm.
So our mission today is basically to pull out the core of Lynch's wisdom, his key strategies, the fundamentals he lays out for, beating the market.
Right.
And we're using excerpts directly from Beating the Street as our guide. We're aiming to break it down, give you the essentials, whether you're, just starting or maybe you've been at it for a while.
Yeah, it applies pretty broadly.
The goal is to get you feeling well-informed, confident, without needing some fancy finance degree. Okay, so where do we even start with Lynch's whole approach? It seems pretty distinct.
Well, I think a great starting point is his really empowering core belief. He genuinely thought that the average investor, you listening at home, actually has some pretty significant advantages over the pros on Wall Street.
Advantages? Really? How?
Yeah, it's fascinating, isn't it? His reasoning was that your everyday experiences, your own knowledge, can help you spot opportunities that the big institutions, they often just miss them.
Okay, that makes sense. And that ties into one of his big principles, right? The know what you own.
Exactly. Know what you own and know why you own it. It sounds so simple.
It does, but it's deep.
It is. It's fundamental. Lynch really pushed this idea. Steer clear of investing in companies or, whole industries that are just a complete mystery to you.
If you can't explain what the company does, maybe pause.
Pretty much.
Hmm.
If you can't explain it simply, maybe it's not the right fit for your portfolio. It's about understanding.
And that connects directly to his other famous piece of advice: invest in what you know.
Yes, absolutely. Think about the products you use all the time, the stores you actually shop at, the services you rely on.
It's tough around you.
Exactly. These could be surprisingly good starting points for investment ideas because you have that direct experience. You're a consumer. You understand, at least on some level, if the business seems to be doing well, if people actually like what they're selling.
And the book is just packed with examples of this, isn't it? Like Eleg's pantyhose.
Yeah, Alex, he talks about just noticing them everywhere he went shopping. That sparked the idea.
Or Dunkin' Donuts, La Quinta,
Yes.
Taco Bell. I mean, these are brands we all know.
Right. And he lists so many more. Chrysler Minivans, The Body Shop, even General Host, which owned Hickory Farms back then.
Wow, Hickory Farms. Okay.
Tier 1 Imports, Sunbelt Nursery Supercuts, Sun Television and Appliances, Bandag, Green Tree Financial, Dillard's,
Keep going.
Crown Cork and Seal, Shaw Industries, General Cinema, Melville, Toys R Us, Pick and Save, Pep Boys, even cars like Subaru and Volvo, or restaurants like Sizzler, Wendy's, Outback Steakhouse.
It's kind of amazing how many potential investments were just part of his everyday world.
But the key insight there, I think, is that he wasn't just seeing these things as a consumer. He was actively thinking, could this be an investment?
Ah, okay. So it's observation plus analysis.
Right. Were they gaining traction? Did they have a strong brand? Did the management seem competent? That everyday awareness was like a powerful first filter.
And that leads to his famous 10-bagger concept too, right? Finding those huge winners.
Yeah, he talks about the 10-bagger, a stock that goes up tenfold. And often recognizing something familiar, something you know that also has huge growth potential.
Yeah.
Well, that's where those big wins can sometimes start.
Okay, so let's say you've spotted a few interesting companies just by looking around. Lynch then gives us a way to sort of categorize them, right? These 6 types of stocks.
That's right. He broke stocks down into 6 categories to help manage expectations. You've got slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Can you give us a quick rundown of each?
Sure. Slow growers are typically your big, mature companies. Think utilities, maybe.
Yeah.
Steady, maybe pay dividends, but not huge growth.
Okay. Predictable, maybe?
Kind of. Then stalwarts, also large established companies, but they tend to grow a bit faster than the slow growers. Reliable names, good foundation, but probably not explosive growth.
Got it. Like household names.
Exactly. Then fast growers, these are often smaller, more dynamic companies, high growth rates, very exciting potential,
But
but definitely higher risk. Things can change quickly.
Makes sense. What's next?
Cyclicals. Their fortunes really swing with the overall economy. Think car companies, airlines, steel, chemicals. When the economy's good, they do well. When it's bad,
They suffer. Right.
hmm then turnarounds. These are companies that have hit a rough patch. Maybe they're losing money, but there's potential for a significant recovery if things go right. High risk, potentially high reward.
Okay. And the last one.
Asset plays. These are companies where the value isn't obvious from their earnings. It's hidden in assets they own, maybe real estate or cash, or even brand names that the market hasn't fully recognized yet.
So understanding these categories helps you figure out what you're actually buying.
Precisely. It gives you a framework. You wouldn't expect a slow grower to suddenly shoot up like a fast grower.
Right.
Knowing the category helps you align your expectations with what the company is likely to do. It shapes your whole strategy for that stock.
Okay, let's circle back to how Lynch actually found these stocks. You mentioned observation, but he really emphasizes this power of observation, doesn't he? It wasn't just about spreadsheets.
No, not at all. It was about being really aware of what's happening around you. And he has so many great stories about this.
Like,
Well, he noticed his own kids were really into certain toys, right?
oh,
And that led him to actually check out the companies making those toys.
using his kids as market researchers.
Sort of. And he also watched his wife's shopping habits. He noticed she really liked stores like The Gap, The Limited, The Body Shop.
Ah, seeing what was popular.
Exactly. Those preferences turned out to be pretty early indicators of successful retail concepts. It's about spotting trends in how people actually behave and spend money.
And that Hanes hosiery story, the L-Eggs example, that fits right in.
Perfectly. He
Yeah.
saw how popular legs were, how convenient, just by seeing those displays everywhere.
In supermarkets, drugstores.
Right. It wasn't some complex analysis at first. It was just seeing what shoppers were actually grabbing off the shelves.
There was another story, something about a school.
Oh yeah, the St. Agnes School example. He mentions how the kids there were early adopters of Pentel pens.
Just felt tip pins.
Yeah. But their popularity among the students was like a little clue about the product's potential success more broadly.
Interesting.
And similarly, he mentions their enthusiasm for Pep Boys, the auto parts place. That turned out to be another good investment signal.
So these stories really drive home that investment ideas can literally be right in front of you.
They really can. Your daily routine, your community.
But okay, Lynch wasn't saying just buy stock in every company whose stuff you like, right? He hammers home the need for research.
Oh, absolutely not.
Yeah,
That's crucial. The observation is the starting point.
the spark.
Exactly. But then you absolutely have to dig deeper. Do the homework.
And what kind of homework did he focus on? What should you look for?
Well, he definitely stressed looking at the company's fundamentals. He specifically mentions checking the balance sheet.
The financials.
Right. Paying close attention to how much cash they have versus how much debt they're carrying.
Why is debt so important?
Because, well, a lot of debt can make a company really vulnerable, especially if the economy takes a downturn or if interest rates go up. So understanding the debt situation is key.
But it wasn't only about the numbers, was it? He also talked about the story.
Absolutely. You need to understand the company story. What's their competitive edge? Why do customers choose them?
What makes them special?
Right. Do they have a unique product? A strong brand people trust? Is the management team any good? Are they experienced? Effective?
So the qualitative stuff matters too.
Hugely. Understanding that narrative behind the numbers is just as important as the numbers themselves. What's great about Lynch's approach is this blend. It's common sense observation, plus that deeper fundamental digging. Not one or the other. Both.
Okay, so we've talked about finding ideas, researching them. What about the pitfalls? What are some of the common mistakes to avoid, according to Lynch?
Yeah, he definitely warns about a few big ones. One is getting swept up in the hype. Buying the hot stock of the moment just because everyone's talking about it.
Without doing your own homework.
Exactly. You have to understand the business yourself. Don't just follow the crowd.
What else?
He also really cautions against panicking and selling during market downturns. If the reasons you bought the stock in the first place haven't fundamentally changed,
If the company is still solid.
right, then letting short-term market fear drive your decision is usually a mistake. Market fluctuations are normal.
That emotional side of investing is tough, though. Seeing your portfolio value drop is unsettling.
Oh, it definitely can be, no question. But Lynch's point is, if you did your homework and you still believe in the company's long-term prospects,
Yeah.
don't let that short-term noise derail your strategy,
Stick to your guns if the reasoning is sound.
pretty much. And related to that, he advises against trying to time the market, predicting the absolute bottom to buy or the absolute top to sell. It's incredibly difficult.
Maybe impossible.
Close to it, consistently anyway, even for the pros. He argued it's generally much more effective to just focus on investing for the long term in good quality companies.
Which brings us neatly to his emphasis on taking a long-term perspective. This isn't about getting rich quick schemes.
Not at all.
Uh,
Lynch was a huge believer in the power of long-term investing. He knew building real wealth in the market is usually, a marathon, not a sprint.
so ignore the day-to-day noise.
To a large extent, yes.
Hmm.
The daily swings, the short-term price movements, they often don't mean much for the long-term success of a really well-chosen company. Patience is key. A long horizon.
And his own experience managing the Magellan Fund must have really driven that home. He saw it work over years and years.
Absolutely. That success really underscores the point. And the book does share some compelling stories from his time there, doesn't it?
Yeah, I seem to recall some examples.
It does. He talks about some specific companies like the big Chrysler turnaround, which was a huge success story for the fund.
Right, the minivan era.
Exactly. And he also highlights the importance of sometimes going beyond just the numbers on a page, like actually visiting company factories or stores.
Kicking the tires, so to speak.
Kind of. And talking to management, talking to employees, getting a real feel for the operations and the challenges. Those first-hand insights often gave him a real edge.
Hearing those real-world examples definitely makes his ideas feel more concrete. Now, you mentioned his principles earlier. He actually laid out 25 golden rules for investing. Can we maybe revisit a few more of those?
Oh, sure. They're great reminders. One is investing is fun, exciting, and dangerous if you don't do any homework.
Okay, back to research again.
Always back to the research, another key one. Your investor's edge is not something you get from Wall Street experts. It's something you already have.
I like that one. It empowers the individual.
It really does. It connects right back to his invest in what you know idea. Trust your own observations, your own experience.
What else stands out?
Well, there's this really simple but profound one. Behind every stock is a company. Find out what it's doing.
Don't just trade ticker symbols.
Exactly. It emphasizes that fundamental analysis, understanding the actual business.
Any others on the long-term view?
Yes, this one is perfect.
Mm.
Often, there is no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. In the long term, there is a 100% correlation.
Wow, 100%.
That's his conviction. It perfectly sums up the long-term perspective. Eventually, the stock price will reflect the business's true performance.
And he really doubles down on his main point with, you have to know what you own and why you own it. This baby is a cinch to go up. Doesn't count.
Huh. Yeah, no room for blind faith or just following tips without understanding why.
It all comes back to doing your own work, having a solid reason for every investment.
Precisely. A well-reasoned basis.
Okay, let's think about the market itself. Lynch wrote Beating the Street back in the early 90s. What were his thoughts on dealing with what might seem like an expensive or overpriced market? Is that advice still useful today when valuations sometimes feel really high?
That's a great question. Lynch definitely acknowledged that markets go through periods where everything seems expensive overall.
Like maybe now, for some people?
Could be argued. But his approach wasn't really about timing the whole market. His focus was always on finding individual companies that were undervalued, regardless of what the S&P 500 was doing.
So hunt for bargains even in a pro-C market.
Exactly. He believed that even when the market seems generally expensive, if you do diligent research, you can always find some good companies with solid long-term prospects selling at reasonable prices. His philosophy was very much bottom-up.
Focus on the specific company, not the macro forecast.
Right. Concentrate on the merits of that individual business, not trying to guess where the whole economy or market is headed next month or next year.
That really puts the power back in the investor's hands, doesn't it? It's about your research ability.
It does. And related to managing your investments over time, he also recommended doing a regular checkup, didn't he? Like a 6-month checkup.
Ah, yes. What was the idea behind that?
Well, he advocated for reviewing your portfolio, maybe roughly every 6 months or so. The point wasn't to constantly trade in and out.
Not about churning.
No. It was about revisiting why you bought each stock in the first place. Do those original reasons still hold up?
Has anything changed fundamentally?
Exactly. Has the company's performance been what you expected? Are there any major new developments, good or bad, that change your view on its future?
So it's about staying informed and making sure your investment thesis is still valid?
Right. It's just a disciplined way to manage things over time. Reconfirm your reasoning.
Okay, so if we were to boil down Peter Lynch's Beating the Street, for someone listening who wants those key insights quickly and effectively, what are the absolute must-know takeaways?
I'd say the core principles are pretty clear and, importantly, actionable. First, use your own everyday observations. Invest in what you know. Let that spark ideas.
Start with the familiar.
Right. But then, always do the homework. Really understand the companies, the financials, the debt, the competitive advantages.
Research is non-negotiable.
Non-negotiable. Also, avoid getting caught up in short-term hype or trying to perfectly time the market. That's usually a losing game.
Focus long-term.
Focus long-term. Remember that patience and sticking with solid companies is generally the most reliable way to build wealth. And understanding his 6 stock categories can also really help manage your expectations for different investments.
So the big message seems to be about empowering the individual investor, you listening right now.
Absolutely.
You don't necessarily need to be a Wall Street wizard with fancy tools. Your own life experiences plus some solid research that can actually give you a real shot at doing well, at beating the street.
That's precisely it. Your unique viewpoint as a consumer, as part of your community, it gives you a lens that, honestly, Wall Street often overlooks. They're looking at screens, you're looking at the real world.
Okay, so here's a final thought for you, our listener, to chew on. Start looking at your everyday life with a slightly different perspective, maybe with an investor's curiosity. The next time you use a product you really love, or you get amazing service somewhere, or you just notice a local shop that always seems busy, pause for a second. Ask yourself, I wonder about the company behind this. Could this be an opportunity?
Just that initial question.
Exactly. And then maybe take that flicker of curiosity and actually dig a little deeper. Look them up online, see what their story is. Becoming well-informed isn't about knowing absolutely everything.
No way.
It's more about knowing where to look, how to start, and how to understand what you find. Your journey to becoming a smarter, more informed investor could literally start just by being a bit more observant today.